welcome to Masters of Real Estate. My name is Matthew Owens, and I have one of my favorite people on the line today, James Bohan, that is also a CPA, also hates the government like myself, and that's how we get along, is anti-government memes and things like that. But welcome, James. Thanks so much for coming on today. I really appreciate it. It's a good time to do this, given tax time is coming. It's time to protect your money from the government and save as much money as we possibly can through some of the strategies that, quite frankly, I'm a CPA, but you've taught me a ton on taxes, right? And I'm focused on real estate a lot more, not deep diving on every aspect of some of the most complex transactions that I've seen, you having to deal with and help us with on the tax structuring and stuff like that. So welcome to the show, man. Appreciate you coming.
Thanks for having me on, Matt. And yeah, it's a great time to be on. Everyone thinks about tax season being that January through April time of the year, but really this November, December time is when you can actually make moves, because in the next few months when the calendar changes to 2025, you're just looking backwards and it's really hard to make any moves that affect 2024.
Yeah, I agree 100%. People don't realize, and I don't do tax planning and stuff like that for other people, but I can tell you right now that every time I've done tax planning with CPAs in the past, it always saves me, triple, quadruple, or way more than that as far as tax savings, because you realize, wow, there is quite a bit of things you can do to decrease your income or shift expenses, and having that plan in place early is super key. Even now at this time of the year, we got about a month left or so, is difficult to be able to actually implement things quickly, right? Like buying property or shifting expenses and having cash for these things, super important from that perspective. And what are some of the things that you see out there that a lot of real estate investors or other people are doing to mitigate their taxes, at year end when you're doing, typical tax planning with people? What are some of the main strategies that you like to see and implement across the board that are pretty common?
I think the most common one for people in any type of business, and if you're a cash basis taxpayer, looking at what you can pay in December, that will be, for future years. So I have some clients that have a marketing team, and, they're talking to them about prepaying all of 2025 marketing expenses in 2024. When you do this, you're also maybe potentially able to get a discount with them by paying it all at once. That's a super easy one for people to do. Buying property, doing a cost seg on that. Those are some things you can do before the year end to take advantage of the deductions within the current year.
That's awesome. And when it comes down to cost segregation study, obviously what that is taking a property, breaking up into a bunch of little pieces away from the building portion. Usually it's broken up, land and building. Break it away from the building portion, and then you turn that into a chunk of that into 5-year property, 7-year property, 15-year property, and then you can front load a lot of that depreciation with bonus depreciation and things like that. There are some dangers, though, to that people need to understand about, some issues with that if you're planning on reselling right away. Can you talk about some of those issues that I think a lot of people promote cost segregation studies? I do. I love them and I use them, but there's some dangers that people should be careful of, right? And can you talk about some of those things?
I think the first and foremost thing to think about when doing a cost seg is, are you actually able to take advantage of those deductions? And that means, are you able to qualify as a real estate professional and take really full advantage of that? There's also a lot of state tax considerations where not all states conform to bonus depreciation, where New York is an example that comes up a lot, where if you take a bunch of losses on your real estate and other activities, that sometimes that gets added back as an excess business loss, and then New York will add back the bonus depreciation on top of that. So you could really end up upside down if you're in one of these aggressive tax jurisdictions. And then I think another point you were alluding to is the recapture. Things that are bonused are recaptured at ordinary income tax rates versus 1250 recapture, which is taxed back at 25%. And then anything above that, that basically gets you back to your original basis in the property. And then above and beyond that is the capital gain if you hold it for over a year.
Gotcha. So there's recapture at ordinary income tax rates up to that original basis, is what you're saying. So it depends on what your tax rate is when you sell it versus what it is now, and how long you can take advantage of the extra funds you you get in your pocket now versus later. So fix and flipping doing cost segs is not a good idea. You're going to be recapturing consistently on that type of structure. I also think, touching on the key piece of that where, you can take this against these losses against passive investments, and then so like rental income, right? I thought for the longest time that interest income was a passive investment, but it's considered portfolio income. I was like, dang it, could have got all that interest income back. But what are some of the other strategies is there ways to create passive income in different ways and get around these types of rules through the creation of structuring components where you're maybe creating royalty income or creating more rental income in different ways? I don't know if people done that with you in the past.
Yeah, so interest income can become passive income if you're investing in something that is in the trade or business of lending. Then it comes through on that line 1 ordinary income on your K1 versus line 5 interest income. Some other ways is if people have traditionally been a business owner, maybe they're taking a step back, and we can look at some of that flow through activity where you're previously non-passive, but now maybe you're in the point of your career where other people are running the ship, and we can get some of your primary income from your business to qualify as passive as well.
Awesome. That's awesome. And I think, there's also income limits on the other side with how much you can actually take against your ordinary income if you're not a full-time real estate professional, with phase-out rules and things like that, right?
Yeah, I think you're talking about kind of the active investor status. There's basically kind of 3 categories people fall into when they're investing in real estate. It's just your normal passive person. You invest in someone else's deal, you're very passive. Let's say you buy a rental property in your own name and you manage it and you have ongoing activities. Then you come to that active threshold. But in order to get any, call it normal apartment rental activity to that non-passive material participation threshold, that's when you have to start qualifying for that real estate professional status, which is over 750 hours in real estate and no more hours in anything else.
Gotcha. Yeah, so be careful when you're doing these types of things to understand your specific situation, of course, to make sure that you're not, you can take advantage of these things and it makes sense for you. A lot of people ask me in the past, well, can I do a cost segregation study instead of my retirement account? I'm like, you don't need to, don't worry about that. You're not paying taxes on that right now. But, a lot of people self-direct their own retirement accounts into real estate as well and do those types of structures. And there's some tax components associated with that as well that need to be really careful about. The business income tax, unrelated business income tax. If you're deemed running a business inside your IRA or your 401k, it can be taxed up to like 50%. So being very careful in those arenas. Is that the right tax rate? Maybe I'm wrong. I don't remember, but I believe that's.
I think it's corporate tax rates is what gets done on a 990 for the retirement accounts.
Okay.
And I always like to tell people, this unrelated business tax income, UBTI or UBIT, as some people describe it, it's just a way for the IRS to kind of level the playing field between tax-exempt entities and taxable entities. For example, let's say you have a pizza shop on one side of the street that's owned by a nonprofit and a pizza shop on the other street that's for-profit. The nonprofit one is at an automatic advantage because they don't have to pay taxes. So that's where the IRS came in with this UBIT idea to level the playing field so the nonprofit pizza owner isn't unfairly competing against the for-profit guy because he could lower his profits, lower his margins, because he doesn't have to pay that tax at the end. So that's where the theory and the rules came from the IRS. And I think when you're thinking about taxes, it's always important to understand the policy or what the government was thinking, if they do think, when they put these things into place.
No, they're just thinking, how can I siphon more money out of the Americans' pockets and everybody in the world's pockets? I mean, that's really the whole goal of the federal government. So, and state governments now are not, and local governments aren't that much better anyways, of course. So I think the whole idea behind this was, have diversity in your states and have choice, and so that these states are not monopolies. The federal government's basically its own monopoly as well, which is kind of crazy. And so when you see this stuff, you're like, okay, if they're going to go out and have this waste that we see all the time out there and spending money on every random thing on the planet and giving out social welfare and stuff like that as well, what's the ways that we can mitigate the losses on our side? And how, in my eyes, it's almost our responsibility to pay as little taxes as we can, to give them less power and less money to work with as much as possible. So how do we take away their power? I really want to start a whole thing of nobody pay taxes anymore. If we all do it, nobody will do it. So no, we all don't pay, nobody will pay.
Yeah, I've been saying for years, it's your moral responsibility to pay as little in taxes as legally possible. Just because the government wastes it, I call it the debt and debt cycle. Debt, they're paying so much of your money to the Federal Reserve, which is a private entity that prints our money, that lends it to the government, and the government pays it back at interest with our money. And
Right.
then they get levered up so much to spend money in the military industrial complex to go bomb people we've never had a problem with personally in
Right.
our lives. It's absolutely insane. And
And,
back to
and
your
it's,
state tax purposes, I actually love paying Idaho taxes. They run their state so well. I even voted to increase local taxes to pay for schools and infrastructure because I actually see the direct result in the street. There were potholes out by my house, and they're fixed within months. It's crazy to see when a government's actually running well on a small and limited basis. I don't mind paying a small amount to Idaho.
yeah, I understand. I look at the entire tax base. I mean, that was the whole idea behind taxes in the first place, that if it goes right into the community and is supporting the community, then great. But when there's theft and a combination of power at the top and money at the top, it's going to lead to corruption at some point. So that's why the diversity of different states and choices, and even cities and counties within states, was supposed to have complete diversity, and they started getting controlled by all this debt, that was put in place by state governments and federal governments to be able to hamper down those cities and localities and create more of a big monopoly. And what's interesting, when we really look at it, we're really paying like 75% in taxes. If you're talking about, I live in communism in Southern California, right? My tax rate is through the roof. Luckily, I'm a CPA and don't pay a lot of taxes because I know the right strategies to utilize, and I plan accordingly, right? So, but at the end of the day, you're looking at state taxes, federal taxes, payroll taxes, sales taxes, property taxes. Gas taxes. There's so many taxes out there that, like, it starts to add up, and when you do the math, it's literally close to 75%. It depends on what state you're in and what tax bracket, of course, and things like that. But if you're making any kind of money, if you're making $400,000-$500,000 a year, which is a great salary, but living in California, if you have a husband and wife making that and a W-2 wage, you're getting destroyed in taxes, right? They're taking like a third or more, 40% plus in that wage in taxes. So their real take-home pay is way less if you're a W-2 worker in that scenario and don't have a lot of tax deductions and strategies to reduce these tax bills. So it's super important when you're thinking about that. If you're like, hey, we're making $250 each, it's $500,000, you would think that person is balling, right? But at the end of the day, when you take out $250 of that, and you take out California living on an annual basis, like it's like 15 grand a month to live, 10 grand to 15 grand a month minimum to live in California, and like it's insane because of the pricing, depending on where you live and the housing, and of course all that kind of stuff, of course. But you can get it down to a lot less, but it's not cheap. And so when you do the math on a middle class household, it really is not that much wealth. And people talk about that and don't understand that it's a lot bigger of a burden than it may seem to the outside party, right? And like when someone's like, dude, if you have someone that really is upset about, make the wealthy pay their fair share, and they realize that wealthy person that's making 500 grand really is only making 250 at the end of the day, it starts to really add up and get a little scary. So, and so, that kind of leads me to the strategies. I know you invest actively and passively, and I think it's important to do both. And especially a CPA like yourself that's helping people with tax mitigation strategies and helping with like the businesses with their taxes and stuff like that. I go to you with all my stuff because it's you're really good at the legal and tax structuring side, but you understand the investment side too, right? And so can you talk to me a little bit about what some of the deals you've done in the past, and what you've learned out of those and how they're helping you on the tax side as well?
Yeah, thanks for that. So I come from a family of real estate developers. I'm a fourth generation real estate developer myself. My grandpa built a lot of stuff in California, and
Nice.
they they didn't do much estate tax planning, and we've had to pay a disgusting amount of taxes in the tens of millions of dollars range as that estate has passed on. So I've been really focused on how to help myself, my family, and our clients structure their estate properly because that's one tax you didn't mention when you were rattling
Yeah,
them all
you're
off. You
right.
know,
I
they
forgot
tax you
about
when
that.
you're
That's
earning
like
it, they tax you when
100%
you
now.
spend it, and they tax you when you die. It's
Yeah.
insane. So, learning from the family about apartments, about apartment management, tenant management. You know, my dad's built all sorts of types of products: office, retail, multifamily. So I really understand the asset class from its core perspective as an owner operator and someone who's grown up in it my whole life. Up in Idaho, I've started to be the key principal on some projects with my family. You know, I turned the first house I bought here up into a single family rental. We bought a 7 key dilapidated motel that I've been slowly redeveloping over the years. We were going to initially blow it up and build a bunch of apartments or a big hotel instead. But
Mhm.
as interest rates and costs rose, I just really leaned into running a hotel. And it's really cool how you can operate a hotel with minimal staff and utilizing technology. So our guests get an automatic door code. We run it very similar to an Airbnb. They show up, get a clean place. If they need extra towels and stuff, you know, we have someone on site for some hours a day. We're putting in a guest closet where they can go get a keypad and get extra little sundries that they need. And
Mhm.
it's just been really cool to leverage technology for this boutique hotel asset class. And, you know, instead of blowing it up, we're adding 3 more rooms this winter as well. And working on getting a liquor license to bring a bar and event center into town as well.
Nice. That's awesome, man. That's really cool. And
Yeah.
you know what? I think you're working on a deal right now that you were talking to me about. And tell me about that strategy on that deal that you're thinking. I mean, the what's the idea behind that particular deal? I think you were talking about doing a BRRRR refinance type project right now. Can you talk about how that works?
Exactly. So I'm closing on this in a couple weeks, and we're buying it, I believe, super under market. It has an unfinished basement per code. And so if you're really looking at our basis in this, if we finish that out and get it to be permitted square footage, which is easy enough to do, we're buying this at $130 a square foot when the market for duplexes is trading at 260 bucks. So we're walking into equity from day one, and we're going to do the BRRRR strategy, as everyone talks about, you know, buy, renovate, refinance, rent. And Coeur d'Alene, where I live now, because I escaped the government in California, I'm in Idaho, and it's really easy to do this. And we're able to rent out some of those units as short-term rentals. And we're in this awesome market where during the summer, everyone wants to be here. You know, my rooms at the hotel were full all summer long. We see a lot of demand for this product. And then we're one of the few markets where we have ski season during winter, so people can come out. There's 3 mountains nearby, so we get some activity during winter. But then also during the summer, when it's prime time out here, everyone wants to be outdoors and on the lake. So it's one of the best short-term rental markets in the country, given that dual season purpose.
That's awesome. Yeah, I keep wanting to go to Idaho more for the freedom than anything else. So, because during COVID, I was like, how do I get out of California? I need to get my farm somewhere in the middle of nowhere and stay away from people and, and be sustainable living. I just bought a bunch of water barrels and excess food
Yeah.
supplies just in case. So I
That was
stocked up
me.
on
I
stocked up
was
on
living that
toilet
dream.
paper like everybody else, So I was like, why is everybody buying toilet paper? Let's buy it too. So,
Yeah, so I live on that farm now. So that's another one of my strategies is I actually cost segregated my farm. And if you look at a farm, there's fences everywhere, there's barns, there's a lot of land improvements. You read through my cost seg report, even trees are on there, orchards, all that kind of stuff. So it's been
that's
really cool to apply that tax strategy also to my small town farm life now.
I'm gonna have you build me my bunker in out there on a farm somewhere. That's the whole plan. So
We
my
got a team
separate
for you when
self.
you're ready.
That's awesome. And I see a lot of potential risk out there on the market right now as far as like, changes happening, right? We got World War III that could be potentially happening now, depending on what happens after the change of power here in the US and even beforehand, it's kind of scary. We have uh, a change in interest rate environment that was very quick. We see inflation starting to creep up and then starting to maybe stop lowering the interest rate a little bit because of that inflation pickup. We're seeing, a lot of credit card delinquencies and stuff like that occurring. And I'm just curious as to your take of the overall market as a whole. We also don't have a lot of inventory as well, right? There's still a massive undersupply of actual inventory that's available to purchase out there compared to historical norms. I don't know that there's an under supply compared to the demand right now because the demand has got hit from affordability. But I'm just curious as to your take on the overall market, what you're seeing out there, and stuff like that as well.
Overall market is a bit scary for all those reasons you mentioned, but remember, real estate is just a very hyper local game. And I
True.
think the microeconomic factors for where I'm at are extremely strong. Anyone who wants a job can have a job. It's a lot of tradesman economy. We don't have a lot of these tech jobs where people are getting laid off left and right. But to echo your thoughts, I do see a lot of headwinds coming there. It's really interesting to see a lot of these Federal Reserve rate cuts happen at the federal funds level, but it hasn't really impacted mortgage rates so much because now mortgage rates are more being priced on a market demand type of level. So it's interesting to see that disconnect happen. There's always a lag. Ken McElroy calls it the ripple effect, where something happens and you have to wait for things to pan out. You have to wait for bankruptcies, delinquencies to work through the system. It's not just like, oh, there's a delinquency, things are bad, and then people get foreclosed on it. It takes, depending on the jurisdiction, 3, 6, 12, 18 months for that to work through the cycle and the system. It just takes, like you eat something and it takes a minute to digest it
Right,
all.
right. Yeah, it's interesting because people think that everything is immediate or there's going to be a change quickly. Real estate tends to move slowly. Even during crashes, it goes down slowly over a period of time. It might be a 5% correction a year is a major crash, right? Like if that continues like that, that's a big correction. But that 5%, you break that over a 6 month period of time or something like that. 2.5% is not like make it or break it on most property sales and things like that. You have time to maneuver when you start to see a correction in the market occurring and stuff like that. A lot of times, unless there's a liquidity crisis, when like we saw in the Lehman Brothers moment, when banks just stopped lending completely because they had no funds and none of them knew they couldn't even lend in the first place, right? They're just, wow, there's no funds available anymore. All of our cash dried up. And so, we just saw some banking issues previously a few months ago as well that occurred. And, I feel like that's one of the bigger risks. And, at the end of the day, like you said, though, the market in itself is the key, right? How much demand is coming into that market consistently? Additional population growth, job growth, the types of jobs you mentioned, people that are working with their hands and getting dirty, they're less replaceable than, with automation and AI too and stuff like that, right? Trust me, as much as I can, I'm going to be getting one of those dang robots so that I can use that in the future. I can't wait for them to be hanging drywall for me. That'd be the most awesome thing on the planet, right? So,
Right.
I do that kind of job, but, that's going to be a harder replacement than, some marketing work and stuff like that. So, but at the end of the day, I think it's time to stay cautionary, but also pick and choose the investments like you're doing, where if you're able to buy a property, renovate it, refinance, repeat it over and over, and rent it and repeat it and do this over and over again and get all your capital out, you have equity built into this thing already for a downside protection. You probably have a little bit lesser leverage. You could also refinance it and not pull out all of your equity out of that deal and leave something in the game to keep even lower leverage ratios. And you have a good strategy that creates a strong cash flow stream with, a really good, I'll say, debt service coverage ratio, where you are, able to, maybe you're at 150% debt service coverage, meaning your debt is covered by the income by 150% of the debt amount. Those types of things put you in a safe long-term position to raise your wealth and grow your wealth long-term through real estate and these types of strategies. And it's a great inflation hedge long-term too, especially when you're considering the underlying financing in place that, you could decimate that during an inflationary market in a fixed rate debt, right? So a really interesting strategies that you're deploying there on this.
Absolutely,
And
absolutely. And I'm
yeah,
telling people, get your dry powder available right now. Keep looking at deals, keep your foot in the game, but just build up that, dry powder so you're ready to execute on a project. If you see something come up like I did with this asset that we're able to buy, I think really under market and implement the time proven strategy of the BRRRR.
yeah, the Bird method is awesome. So, and I'm seeing a lot of people come out now and try to buy properties subject to the existing financing just because previous financing was 3.5, 2.5%. They don't want to get rid of that stuff. They might as well take advantage if that's a possibility. I don't know how well no money down, or I'll do a 10% down and give you your price, but I want a 30-year mortgage at $500 payments a month with no interest type stuff. You see some of these creative people coming out with some crazy offers, and they're just preying on people that don't have the right education, and maybe they get 1% or something. Who knows? But I've seen some of these insane offers on strategies people are trying to deploy.
Yeah, I have no idea who those people are, who counterparties are, and how they're able to get those deals done. It's everyone thinks, oh yeah, just do a sub two and seller carry back the whole thing, put no money down, and they countered back at like 5% down, but we still said no. I'm like,
Yeah,
you're crazy. You're absolutely crazy
yeah,
in
yeah.
my mind.
5% down with it's like no interest for 30 years and 100% principal payments. You're just like, wow, like I want that deal. But I think I'd have an ethical problem with some of those, even though it's hard. But you're like, man, I just feel bad because this person doesn't know, what they're
Yeah.
doing. It's a 30-year loan with no interest. That's horrible. So let alone the inflation aspect of it that destroys that debt on the 30-year loan, right? So, but these types of strategies exist. There's lots of different deals out there. I think people don't realize though, like you're active in this space, but you also invest passively in different deals as well, right? And so, when you're investing passively or you're looking at a passive deal to invest in, do you go through and like what do you do on the vetting side? How do you find a good operator out there, or make sure you're not getting in bed with somebody that doesn't know what the hell they're doing, right?
I become their CPA and
Oh,
see
there
how
you go.
and see how they're actually operating. So I've invested with my clients in the past before, and it really helps me build that level of trust of knowing people who have the right integrity in the
Right.
market and who are treating their back office seriously. And sometimes, I've fired clients in the past, not just because one, I don't want to invest with them, but two, it's just like, hey, I'm not on board with the way you're operating, and I can't be your CPA anymore if you're going to
Right.
act like this.
Yeah, you see, commingling, you see problems that are occurring, you see, their back office just not getting you the information that you need, so that they're not put together themselves on these things. And I think, being a CPA in the space as well, I think it's really difficult to to for a normal investor or a normal person without the finance background and that aspect to really vet deals in their entirety, because if they don't understand that piece of it, it's going to be hard to know if the operator knows their stuff or not, because you're talking about the entire CFO function that could be lacking on a deal, right? Where you're dealing with the operational controls, the payment systems, the reporting to investors, the quality control, the asset management, all these different parts of this go into the CFO function from a cash management perspective and everything else. And it's really hard. That's not an easy part of the job, right? And that it's a necessary part of the job. And so being able to dive deep into operators and who's on their team in those areas, I think, is really important to understand before you invest with somebody, because of that financial control aspect, right? And understanding, because nobody teaches financial education or how to run a business, right? I met with flippers in the past where they came to me and they're like, yeah, we're doing 10 flips a month. Here's my balance sheet, my income statement. Can you explain what these are? I'm not understanding. And you're looking at these, and I'm like, what about this deal? Let's go line item by line item through their balance sheet. And they're like, well, that house was sold years ago, and this one was too, and so was this one. Why is it still there? I'm like, because you never wrote it off and just cut a check for way more money than you should have to the IRS, because you didn't write off the cost basis of your sale, in the first place. And good news is, hopefully, we can go back and do an amended return and get you some money back. But this is something that needs to be done at a business owner aspect, and make sure they know what their financials really are telling them in the first place. And after running a lending company and a property management company, you realize that 90% of people do not have their financials in order, right? So, and being a CPA, you probably fired a lot more than a couple of clients for the same reason, I would assume. So,
Absolutely. And coming kind of from more an institutional space when I was working at KPMG and working as CFO of a fund, investors, these institutional investors are going to ask you, who's your auditor? Who's your CPA? Who's doing your taxes? Who's your
right,
fund administrator? That's
right,
something I rarely ever hear in kind of the more syndication fund to funds fund model space.
right.
These things are incredibly important. So to the passive investors out there, start to demand this stuff from the operators. Start to understand what their back office function looks like. is there another set of eyes on the books? Is there someone else doing the books, not just the operator? And they're looking at their balance sheet that they've never prepared before in their life and
Right.
sending you something that they have no expertise in preparing.
Right, right. Yeah, and that whole piece of it is key, I think. And but they could have the right team members. They could, if they put the right team members in place. It's a matter of that making sure that that team member is the right fit and knows what the hell they're doing, because it's hard from a business owner without that experience to know if they have a good operator or not, or someone in the CFO spot that knows what the heck they're doing, right? Especially if certain CFOs may be good for one business, but have no idea anything about real estate, right? And so that could be a bad CFO for real estate, right? Because that CFO should be able to look at the numbers and be able to tell them, hey, this is operating efficiently or not efficiently. These are the things that are really you need to focus on delinquencies or vacancy rates or timelines and all types of stuff like that from a financial decision-making ability, including, should we sell this property right now? Should we hold this property? What's the highest and best use of that asset? And can we do a review of that asset consistently every year to make sure we're still dialing that in from an asset management standpoint? Because that CFO function goes very deep into the asset management function of these assets, on that decision-making ability of what's best for everybody involved, So you start to see that it's scary out there, especially in the fix and flip business. You see some lack of sophistication out there, and it just is like, whoa, that's a tough one, right? Like, and it's not just that; it's who are their team members. Like a fix and flipper, for example, who's their contractor, and are you fronting all their money up front, and then they're bad at the contractors bad at money management? You betcha they probably are. The most contractors are out there working on the job. They're not taking a look at their financials. If they got money in their account, they think they're okay. And they don't know how much they really spent versus their budget in a lot of times out there with GCs even. And so it's just not their skill set. So it's important to be able to manage that that risk and make sure that things are going into the project. I got hit with it a few times. I was too busy, and a contractor stole $500,000 from us. That's a tough swallow, He was purposeful theft and getting us fake receipts and fake permits and all kinds of fake signs off from the cities and all that stuff. But I made a mistake, and I saw it right there, and I was like, damn, that hurts, So when you do that kind of thing, so how can people reach out to you and get a hold of you, man, for the tax stuff? Because I think you're extremely valuable on that side. You helped me massively with structuring my entities in my business. And I think you have a lot to add on the estate planning side and things like that, to take a look at, small business owners' major systems and their major structures to say, hey, this is the ideal structure. How do you shift this into this better structure? But how do they get a hold of you to be able to go over these types of things and get that proper planning done?
So I'm available at stonehan.com. That's stone like a rock, Han like Han Solo, my last name. I combined my grandpa's last name with mine and created this company, Stonehan. I'm active on LinkedIn, James Bohan, CPA, MRED. I'm on Instagram at James Bohan, CFO. And to your last point there, I think people really need to make an honest assessment of where they are as an entrepreneur, where their skill set lies. Like, there's great builders out there, but like you said, they're not great at the finance and accounting. And
Right.
to hire a quality person, is expensive, but they're going to save them money in the long term. It's
Right.
just like attorneys. They charge a lot of money, but you never see the money they save you at the end of the day. So
Yeah.
for me, I suck at marketing social media, so I hired a firm to do that. I made an honest assessment of my abilities, and I'm paying, good money to great people to help this aspect of my business. And I think as entrepreneurs and business owners, they need to really understand where their strengths and weaknesses are and bring team members on, whether internally, like you said, or externally, to help make sure their ship runs smoothly.
All you got to do for marketing is show your Halloween costume with you holding a gun, like this in your American outfit. That's all you got to do. You'll get all the clients you need right there. That's
Yeah,
perfect. So
we're
awesome.
trying
Well,
that
hey,
now.
thanks so much for this conversation. If anybody wants to learn more, we have a 200-point due diligence checklist that we use, and for all of our investments when we're investing with other operators and things like that passively, and that is available on our website at matthewowens.com with one T in Matthew. My parents couldn't spell, so that's what I say when I say one T. But anyways, so yeah, MatthewOwens.com. You can download that due diligence checklist. And we also have a quick analysis sheet on there that you can analyze any deal very quickly. We also have a master class on how to raise capital, how to find deals, and how to analyze deals. So just trying to provide resources for everybody. So I hope this helps. Thanks a lot, James. Really appreciate the time today, man.
Thanks for having me on, Matt.
Talk to you soon.
Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. Three of the key pillars to becoming a successful real estate investor. Number two, you can join us on our mailing list where you'll get tips and tricks on real estate investing directly to your inbox. And number three, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.